Sometimes the best lessons don't come from a textbook. They come from the real world, or in this case, a really, really good simulation. Today, we're diving into the story of how a group of students turned a school project into an absolute masterclass on how to invest. And trust me, it all kicks off with one very impressive number. 100,000. That's how much virtual money these finance students were given to start with. Just to give you some perspective, in Malaysia, that's more than double what the average person makes in a year. So, yeah, even if it wasn't real cash, the stakes felt pretty high. So, let me put you in their shoes for a second. Imagine that money lands in your account. What's your first move? How do you even start to think about growing it? That's the exact question these students were up against. Okay, so here's the setup. Think of it like a flight simulator, but for investors. They were tasked with taking all the theories from their classes and actually using them on the Malaysian Stock Exchange. They had their 100 grand, one big rule: they could only invest in Sharia-compliant companies, and a really clear goal: make money, but whatever you do, don't lose that starting capital. So, where'd they start? Well, like a lot of people new to the game, they were drawn in by the promise of getting rich quick. Their opening play? They went straight for the most exciting, high-risk, high-reward things they could find: penny stocks. So, what exactly are penny stocks? Well, think of them as the lottery tickets of the stock market. They're super cheap stocks from smaller companies, and their prices can swing up and down like a roller coaster. That volatility is what's so tempting. You could make a huge profit, like overnight. But, and this is a big but, you could also lose everything just as fast. And wow, just look at this. This is a peek into their early trading journal. You can see right away what their strategy was. It's all about buying and selling fast. I mean, they're jumping in and out of the same stock on the same day, trying to skim tiny profits off these little price jumps. It was a total frenzy. And as they were about to learn, it was a really dangerous way to play. As you can probably guess, that high-octane strategy wasn't sustainable. The initial thrill started to wear off, and the cold, hard reality of the market began to set in. It was time for a serious reality check. This line, pulled straight from their own final report, says it all. The very thing that made penny stocks so exciting, that wild volatility, was actually their biggest enemy. It was just too unpredictable, and it put all of their virtual capital at huge risk. This was the moment they realized, okay, this isn't working, we have to change. And this is where the story gets really good. They didn't just try a little harder. They completely changed their approach. They went from just guessing and speculating to building a disciplined, repeatable strategy. They created a new playbook. Their new playbook was built on two simple but incredibly powerful ideas. Think of it as having a great defense and a great offense. Pillar 1 was all about defense, managing their risk so they wouldn't lose their shirts. And Pillar 2 was the offense, using real analysis to pick the right stocks. So every decision was based on data, not just a hunch. A huge piece of their new defense was something called a cut-loss strategy. It's basically a safety net for your investment. Before you even buy a stock, you decide on the absolute lowest price you're willing to let it fall to. If it hits that price, you sell. No questions asked. It takes the emotion out of it, which is so important, and it stops a small, manageable loss from spiraling into a disaster. They took that idea even further with their 2% risk rule, which is just brilliant. First, they made a rule: no matter what, we will not lose more than 2% of our total money on a single trade. For them, that was 2,000 ringgit. Then, and this is the clever part, they used that number to figure out exactly how many shares they were allowed to buy. It automatically controlled their risk on every single trade. It's all about controlling what you can control. All right, so with their defense locked in, how did they pick their stocks? They used a two-part system. First was fundamental analysis, which is basically digging into a company's finances to answer the question, what company is actually worth buying? And second was technical analysis, which is all about looking at charts to answer the question, okay, when is the right time to buy it? So to figure out what to buy, they made a simple checklist. They only looked at companies that had a positive return on equity and a positive earnings per share, basically proving the company was healthy and actually making money. They also wanted to see a solid EBITDA margin, which is a good sign that the company is run efficiently. This simple checklist filtered out all the weak businesses right from the start. Now, once they found a good company, they used their technical tools to decide when to jump in. They looked at things like moving averages to see which way the stock's price was trending, and they identified support and resistance levels. You can think of those as invisible floors and ceilings for the stock price. The idea was to buy near the floor and think about selling near the ceiling. Smart, right? So, They had this whole new system, a strong defense, a smart offense. They completely changed how they operated. But the big question remains, after all that, did the new playbook actually work? Well, here it is. This is the final screenshot from their portfolio at the end of the whole simulation. I mean, just imagine being one of those students, logging in and seeing this number for the first time. You can see the total value and that all-important profit line. So let's just cut to the chase. The final profit was over 136,000 ringgit. They made more in profit than the 100,000 they started with. To put that another way, that's a return of more than 51%. 51%! That is an absolutely incredible result. What a turnaround. And really, that's the number one takeaway from this whole story. Their success wasn't about getting lucky or finding some secret stock that nobody else knew about. Not at all. It was about building a process, a system, and then having the discipline to stick to it day in and day out. Which really makes you think, doesn't it? For them, discipline was the key that turned a game into a huge win. So the final question is, where in your own life, way beyond the stock market, could that same kind of disciplined process make all the difference?